Natural gas is one of the primary sources of heating fuel throughout the entire world, and it's one of the most important fossil fuels because it can be used to produce electricity. In addition, it's both plentiful and cleaner burning than a lot of alternatives. However, due to the fact that the United States has a huge oversupply of natural gas, and it's very difficult to transport because it needs to be liquefied and cooled to a certain temperature, there are very low prices going on in the natural gas industry right now in the US. Experts on international relations believe that Putin, the leader of Russia, may try to do damage economically to Europe by cutting off their natural gas supply. If we don't have an unseasonably warm winter like we did last year, Europe could be in a lot of trouble. Fortunately, since the Ukraine war started, the United States has been accelerating the manufacturing of those tankers needed to get liquefied natural gas over to Europe. Analysts believe that this spike in demand from Europe could cause the cost of natural gas to spike as much as 3 times since current levels, with some bulls predicting it to go even higher than that. The downsides to natural gas is that it is a notoriously volatile market. In fact, many traders refer to natural gas as the Widowmaker because its tendency to whipsaw in price will kill both bulls and bears out of their trades. Additionally, even though it is rare, if we do see another unseasonably warm winter, then the price of natural gas could stay where it is until a catalyst makes it go higher. Due to the volatility of natural gas, I choose not to play this space with the futures, and instead I use the US Natural Gas Fund with the ticker symbol UNG. It's critical to remember, though, that this is a fund, which means that if the price of natural gas stays the same, the fund's price will continue to go down because there are maintenance fees that detract from its profitability. Because this is a speculative investment for me, it is in my speculation in play portfolio, which means that its allocation size is very small when compared to the other portfolios I manage. I think it's an interesting space to play a trade in, but I don't think of this as a quality long-term investment. It's simply too volatile. I added to my UNG position on the 20th with a 5.81% buy at $6.75. This buy lowered my per share cost 1.82%, down from $8.25 to $8.10. And as you can see, I'm making very small buys as it sells off. Again, it is so volatile that you have to be that careful. My next buy target is at $5.90, just above UNG's all-time low. And I will start taking profits in this position if it exceeds my cost basis, with my next profit-taking target at $9.05.